The hammer candlestick is essentially the same as the hanging man, but it must appear in a downtrend. This is a bullish one candle pattern that indicates a possible reversal. So the hammer, just like the hanging man, must have a small body, which can be black or white, and it must have a long lower shadow. The longer the lower shadow, the stronger the signal. So this pattern shows that sellers have taken the market down, but buyers have bought it back up and the market has finished near to where it started. So this indicates that momentum is slowing and a new uptrend may be about to take place. It also suggests the market may be hammering out a bottom. Here's an example on the chart of DD, shown by the green arrow. You can see the longer lower shadow where the market has fallen, but then the stock has been bought back up by the bulls. And you can see this set in motion a decent upward move. Here's another example in the chart of HPQ, Hewlett & Packard. So now we have the hammer candle pattern written down in code. We can run it through the AmiBroker simulator and see how it gets on. So in this instance, we will be buying the market on the close whenever there is a hammer and the market is in a downtrend, defined by a new 10-day low, because this is a bullish signal. And we're then going to close the trade after 1, 3, 5 or 10 days. So looking at this first table, you can see the results from buying the hammer and closing the trade after 1 full day. And you can see that this was a losing strategy overall. On our 21 markets, the signal produced an average loss of 0.1% with an average win rate of 46%. This was worse than the average one-day return for each market combined, shown by the benchmark. Across our 100 stocks, the signal did even worse with an average loss of 0.17% per trade. Again, this was lower than the benchmark daily return of 0.04%. Combining the hammer with a 3-day holding period lost money again in our 21 markets, but it produced an average profit of 0.09% per trade in stocks, with a win rate of 52%. Buying the hammer with a 5-day holding period was a very similar story. We saw an average loss in futures and forex and an average profit of 0.09% per trade in stocks. With a 10-day holding period, the results are still not great. We saw an average loss of 0.01% in our 21 markets and an average gain of 0.19% in stocks. Overall, these results are not good. The hammer pattern does not seem to show any profitable edge in the markets we tested, and we underperformed the benchmark result in every test. In other words, we would be better off buying the market randomly than waiting for a hammer. Let's move on now to the inverted hammer.